David Buckland and welcome to this week's Video Insight. As many viewers will know by now, Montgomery Investment Management has re-engineered its business model whereby we're effectively a communications, marketing, sales, compliance and operational business with 4 high-quality investment partners. On the left-hand side of the slide is the domestic large cap equities, which has been run by the team at Australian Eagle Asset Management since September 2022. The division second from the left comprises the Montgomery Small Companies Fund, which focuses on smaller listed companies in Australia and New Zealand and is run by the team from Montgomery Lucent, and that's been going since September 2019. Global Equities is the third division, second from the right, and Pollen Capital run the Pollen Capital Global Growth Fund out of their head office in Boca Raton, Florida. And the Pollen Capital Global Small and Mid Cap Fund is run out of Pollen Capital's Boston office. The fourth division on the right-hand side of the slide is the domestic credit or high yield credit, and more on this in my next blog. Today, I really want to focus on Australian Eagle Asset Management and the fact the team are prepared to analyse unloved companies which are seeing an operational turnaround, yet to be fully recognised by the market. The best example I could give was when China started re-inflating its economy back in early 2016, and that saw the share price of Fortescue Metals Group, ASX FMG, appreciate more than tenfold from around about $1.70 to around about $17 in sub 6 years. A more recent example of an improving quality company with a strong valuation case is, surprisingly enough, the AMP, which has seen its share price appreciate from under $1 to $1.33 in the past 5 months. And its market capitalisation increased from about $3 billion to $4.1 billion over the same period. AMP has experienced several difficult years since the Financial Services Royal Commission burdened it with regulatory fines, and this triggered constant negative press and a lot of management turnover. The company's most recent results confirm significant progress being made by new management with the divestment of Colomite Capital, formerly known as AMP Capital, which will result in a strong surplus capital position and likely a special dividend. The Advice Division's losses have more than halved from a year ago, and it appears on target to break even by 2024. Meanwhile, fund outflows hitherto experienced in the wealth management have slowed, aided by the prized AMP North platform, which continues to attract inflows despite operating under the tarnished AMP brand. AMP Bank also remains a steady contributor to group earnings, with recent growth outpacing the rest of the industry, and the digital-only offering is gaining traction with new and existing customers. Australian Eagle's investment thesis begins with considerations of downside risk. With a surplus capital of around about $2 billion after the sale of assets and a valuation of over $1.5 billion for AMP Bank, based on book value, AMP's market capitalisation at the time of purchase suggests shareholders are receiving the $100 billion plus multi-platform AMP North business, plus the Australian and New Zealand advice business, plus a share of the Chinese asset management business and pension business for free. After several missteps, it appears that management are finally delivering upon promised improvements, asset sales and return of capital to shareholders, and we believe recent progress provides positive objective evidence for substantial market value upside. That's all I have time for this week. Please continue to follow us on Facebook and Twitter.